Hello and welcome to Gold and Silver Assets. It's Sunday the 8th of November 2020. A few of the comments from the last two videos got me thinking about what the potential upside of the gold and silver miners could be. Last week we looked at this chart of the Barron's Gold Mining Index to gold ratio. And we noted that this is on the log scale and it only goes back to 1950. I found the equivalent chart on a linear scale going back 100 years, so this is much better. Last week we were talking about how some of the ratios have been shown to be mean reverting, but I don't think anyone's looked at this ratio, but eyeballing it, I don't think it is one of those ratios that mean reverts. I mean, there were times when it did. So for example here, where we got this kind of movement, and of course over here as well. But on the bigger time scale, I'm doubtful that we can say it's mean reverting. We kind of need a quant really to tell us if that's the case. Right now, it takes less than half an ounce of gold to buy a share of the Barron's Gold Mining Index. And you'll note here that it's actually the same level that it was in the 1920s. The green shaded area over here shows when gold price was fixed at $35 an ounce. And the yellow shaded area is when gold was allowed to trade on the market. On this chart, an upwards move in the chart means that the miners were outperforming gold, and the higher the value on the chart, the more expensive the miners are relative to gold. So here would have been a good time to swap the miners for gold. This exponential rise in the ratio is particularly interesting. At the time, the gold price was fixed and gold investment was banned in the USA at the time. However, investment in the gold miners was possible, and any rally in the miners would cause the ratio to rise since the gold price wasn't allowed to budge. Interestingly, the ratio began to drop here, which was about a year before the gold price was free to rally. And the ratio plummeted from 1969 to 1980. That means that the miners underperformed gold. In nominal terms, though, remember that the Barron's Gold Mining Index went from 231 to 736 over this time period. So that's triple. But remember that the gold price went from $35 to $822. So that went up 23 times. Although both of these assets did perform well, you would have been better off owning the physical metal rather than the miners during that bull market. The underperformance of the miners could be attributed to the preceding suppression of the gold price, but note that since then the miners have continued to underperform. Why is that? Here are some of the reasons that I came up with, but do let us know in the comments if you can think of any others. We've got things like high energy costs, which have hurt profits of the miners, declining ore grades, and the introduction of gold ETFs. So let's look at each of these in terms of the charts. Starting with energy costs, if you consider both direct and indirect costs for the average gold miner, approximately 50% of gold production costs are closely linked to energy prices. So above is that ratio chart of the miners to gold ratio that we saw earlier, and below I've got the inflation adjusted oil price. And we can see a general pattern is that when we have rising oil prices, we get underperformance of the miners. And that does kind of make sense. Of course, the recent low oil prices have therefore been very good for the miners. This is a chart that I created that I haven't seen anyone discuss before. The bars represent the oil price, and the blue line is the oil price to gold miners index ratio. Here I've used the XAU Gold and Silver Miners Index to represent the miners, as that's the only one that had the longest history on TradingView. But I would really love to see this ratio chart in terms of the Barron's Gold Mining Index over 100 years. That would be a very interesting chart. However, if we look at this, then that actually confirms what we discussed in the last slide. When the oil price rises, the ratio rises. And that means that oil outperforms the miners when the oil price rises. Any spike in the oil price would hold the miners back. It's well known that ore grades have been steadily declining over time, and that makes sense because the easy to mine high grade deposits would have been mined first. Ore grade is now a tenth of what it was in the 1970s, and of course the lower the grade, the more energy is used per ounce of gold mined, and so that's another factor that's likely to hold the mining sector back in general. The mid to late 2000s saw the introduction of gold ETFs, as well as gold mining ETFs. So the GDX was introduced in 2006 and the GLD ETF opened in 2004. If we look at the ratio chart, around 2004 to 2005 and 6 saw a plateau in this ratio, followed by quite a big decline in the ratio. I'm not sure if that was a contributing factor, but things like leveraged gold ETFs may have diverted investors away from the miners by offering leverage to the gold price without having the mining risk. Okay, enough doom and gloom. Let's look at the flip side. What are the factors that could mean miners actually outperform gold? One possibility is that if there are other sectors in the stock market that are performing poorly and investors are looking for a rising sector, then that could potentially bring money into the mining sector. If there's any sort of failure of the gold ETFs, that may divert some funds into mining stocks. Also, never underestimate the power of sentiment and manias in pushing prices up rapidly. For the Americans out there, you say tomato, I say tomato. You say beta, I say beta. Anyway, sorry, I'm not very good at doing other accents. As we have seen in previous videos, gold mining stocks are highly correlated to the gold price, meaning that they tend to move in the same direction. But they also provide leverage or beta to the metal. The beta of the gold miners can be considered as a measure of their sensitivity to the gold price, and a high beta implies high volatility. When beta is 1, then both assets move by the same percentage. The average mining stock has a beta of 2 to gold, meaning that a 1% move in gold is associated with a 2% move in the miner in the same direction. Of course, we are talking averages here, and there will be some individual miners that have a much lower or much higher beta, and the value does change over time. It's not a static number. For the GDX, the beta has ranged from a maximum of 2.84 to a low of 1.1. I was actually quite surprised to see that the beta of the GDXJ was actually lower than that of the GDX. And so the maximum was 2.3 and the low was 1. Here we've got the beta of the silver miners, so this is the SILJ, compared to the silver price. And unsurprisingly, the beta is higher with a maximum of 3 and a low of 0.8. When considering upside potential, we must also include time in that consideration. If we label the start of the bull market in the mining stocks as being in 2016, then we're actually pretty advanced. This chart shows the timelines and returns of multiple BGMI bull markets. When compared to the longest running bull markets shown here and here, that means that there is potential for another 3 years left to run. And remember that most of the gains do come near the end of the bull market. In conclusion, I think that the oil price will play an important role in the performance of the gold miners relative to gold, and that will be something that we should be watching out for. Just because the sector as a whole underperforms, that doesn't mean that individual miners will do so. For example, a miner that discovers a massive high-grade gold deposit that's easy to mine will, of course, outperform. The other thing to remember is that underperformance is not the same as poor performance. So this is not to say that the prices of the gold miners are going to go down. We're just talking about the performance of the miners relative to the physical gold or silver. I've put all the show notes and the charts from this presentation onto the website for those of you who want to have a closer look. Then head on over to goldandsilverassets.com. Next up, the market update. Let's start with gold priced in US dollars on the daily scale, and we certainly had a very interesting week. We've been talking about this upsloping channel, and we had a breakdown from that, and it met the target. So the target is the height of this channel, which it certainly met, and actually just turned around and moved back up. There are a few things to note here. So first of all, ever since August, we've been having lower highs, and that's now changed, and we have a higher high, certainly on this time scale here, and we've also got a higher low here. So this suggests that certainly in the short term, we've got a potential reversal over here. This downtrend seems to have halted, and so this may well be the bottom, and we've got a few pieces of evidence to suggest that that may be the case. And remember that the last few weeks we have been talking about downside potentially down to just below 1800 over here, and here we've got the 200-day moving average. Is that out of the question? Well, I think I'm a bit on the fence about this. We've got a couple of possibilities, and at the end of the day we've just got to think about what the probabilities are. This pattern where we've got a new high over here is evidence that we're going to go to the upside further. On the flip side, we have hit this resistance level, which is the underside of this channel, and it's had 2 goes at it so far. And the other thing is that we've got this indecision candle over here. So at the moment, I think it could go either way. I have to say the probabilities are favouring upside just because of this change in the direction of movement here. We've also got a few other factors that favour upside as well, which I'll talk about in the rest of this presentation. But at the moment, I don't want to completely rule out one more leg down. But for those of you who are thinking, oh, should I buy now? Look, if you're a long-term investor and you favour the bullish case like I do, then if you think about it, your downside, I think, is limited to about $150 to $200 max, I would say. But obviously there's a lot more upside than that to go. So you've got some asymmetry there. If you're more short term, then that's a whole different story. Why else do we favour a little bit more upside? Well, if we look at the seasonality chart, we are over here roughly. And so this suggests a little bit more upside to come, but then another dip in November before making its big move into January. Next year, I reckon, is going to be a print fest, which will be good for gold. But between now and December, I'm just a little bit cautious. What could this mean? Obviously, this seasonality chart shows averages. It doesn't say that this is necessarily be exactly what happens this year. And it could be, if we go back to the last chart, that if we go back up from here, then we could maybe hit a bit of resistance, dip down before making that big move up, which I think is coming in January. The other thing to remember in terms of buying gold and silver as well, if we're looking at the last quarter of the year, the best months to buy have traditionally been in late October and mid-December. So it's very, very difficult to tell you whether we have hit the bottom or where exactly the bottom is going to be. And so you've just got to make your own judgment depending on what your trading style is and what your long-term goals are. Let's have a look at silver priced in US dollars on the daily scale. And again, we seem to have changed direction. We made a higher low and we've also just made a higher high. I've drawn this channel by joining these two lows and then cloning this line and moving it up, and that has actually fit perfectly for these two highs, which suggests that this is the price that we're going to look for if we're looking for a breakout from this channel, and that would fit with this resistance line which we drew months and months back at 26.13. We've also got this trend line here, and just like gold, it's just testing the underside of that trend line. So we're in this area here, which could potentially provide resistance, but if we break through, then I think we're looking at another leg up to 28 or possibly even the 30 level. And again, if we think about that seasonality, then potentially maybe it will come back down before moving back up again. And moving on to the miners, this is the GDX on the daily scale. And last time we spoke, we were down over here, and I was wondering whether we were going to break out downwards to test this 200-day moving average. But no, price just shot up, and we've got a few gaps on the way up as well. It was a very exuberant rally there. And again, that would favour more upside in gold because we've got this downsloping channel here, which kind of looks like a flag, and price has moved up towards the top of that channel. If we go up above 42, I think we've got more upwards moves to come, and I think the next resistance level is in the mid-50s. So the breakout level to watch out for the miners is 42. Could it turn back down and come back down here? Potentially, but it's becoming less and less likely as time goes by. In terms of drawing this top line, because it could be said, oh, we've already had the breakout, because if you join these two highs, then yes, that would be the case. What I've done, again, like with silver, I joined the lows from here, cloned this line and just shifted it up, and made it touch that first line there, and so that's where that's come from. But yeah, I'm not sure which of those is correct there. Now, one of the things that is making me cautious on the downside for gold is if we're looking at the US dollar. It could be, we're right on this line here that we drew. This line has been drawn by joining the lows from here and over here. And it seems to be providing support more recently. Now, if we look at these lows here, it spent quite a bit of time testing it before it made its move up. Here, it only tested it once really, and then just shot up like this here. And here again, we're just testing it. Now, if this breaks, that's going to be huge. Basically, that because of the way this pattern is, this is going to suggest a lot of downside, at least to 84 to start with. But we need to see a break of this line, and it's got to be a kind of decisive break. If you get a wick below it and it doesn't close below it, then I'd be a little bit more cautious there. There is another possibility by joining this low and this low, which gives us a different line, in which case it already broke out down here, went up to retest and is on its way down. I'm just a little bit cautious about that because we've only had two kind of tests of it really. And, this was just a brief, whereas this was a little bit more sustained. Whereas with this darker line here, we've had lots of good tests of it, which makes me think this is a little bit of a stronger line. And this is on the weekly scale, but if we look more closely on the hourly scale, we've got this kind of pattern here. And this line here is that larger trend line that we saw on the weekly scale, that lower trend line. A break of that is going to mean a lot of downside for the US dollar, which is going to be great for gold. And so this is something that I'm going to be watching quite closely this week, what's going to happen with this. If this doesn't break, then because of the way this pattern is, this could potentially be quite a strong upwards move, which is what could propel gold down to those levels that we were talking about before. I don't know which way it's going to go. And the thing with these charts is that there are some times where you can feel a lot more confident than you can at other times. And so this is one of those times. So in summary, for gold, we would need a close above around 1955-ish on the daily bar chart to be more confident of further upside. And with the miners for the GDX, we'd need a close above 42. If those things happen next week, then I'll be a lot more confident of more upside to come. And just to let you know, I've put timestamps in the comments section, so it's pinned to the top of each comment section. So if you're looking for any particular topic or chart, then that's the place to look. Just click on the time and it will take you straight there. So thanks to one of our viewers who suggested doing that, and hopefully that'll be really helpful to you all. That's all for this week. Don't forget to like and subscribe, and we'll see you next week. Bye.